Hi, this is Mani from bsc2nse.com. So in this video we are going to talk about Fibonacci retracement and how to use it to enter and exit the stock market, especially as a long-term investor or even as a trader. So subscribe to our YouTube channel for more such interesting videos that will keep coming from our side. So getting back to Fibonacci retracement, the popular Fibonacci ratios are 24%, 38%, 50%, 62 and 100%. So basically we're going to discuss what these mean and how to apply these ratios and how you can actually manually calculate this, because I think a lot of websites will provide you like Fibonacci values, but they don't actually tell you how to calculate, because once you understand how to calculate it, then you will probably understand how to apply this as well, because a lot of people just blindly say okay, we are close to a Fibonacci level, but they don't finally end up seeing how to make use of that. So out of these Fibonacci ratios, 38% and 62% are the most prominently used, and there's been a lot of mathematical discussion you can see on the web. And 62% is also a Keith number, and the number 61.8 becomes a popular discussion in many fields, not just the stock market, in many areas where common patterns are observed, uh, common natural behavior or common patterns are observed. So just to give a brief before we move on to a chart wherein I can like simply explain how this is used. So basically the Fibonacci retracement, as the word retracement means, as we go along a particular trend, let's say an uptrend, let's discuss about an uptrend. Um, Assuming we are on an uptrend, we are not going to continue simply moving up all the time. There's going to be a point where people are going to book profits or exit in the interim, and the markets will retrace a bit. By retracement, we mean that in an uptrend there will be a short correction or even a bigger correction, and at the end of the correction, it will again continue that uptrend. So this Fibonacci retracement is nothing but it tries to predict how much a particular trend is going to retrace, and before it continues on the overall long-term trend or the bigger trend, um, or the primary trend. So again, as you can see here, Fibonacci retracement is based on the idea that markets will retrace a predictable portion of a move, after which they'll continue to move in the original direction. So, for example, the Indian economy or the US economy, these are all economies which are growing at 3%, 5% every year, or 8%. India used to do 8% in before 2008. So they are all growing economies. There is no doubt about that. Among all the other countries in the world, there are few countries like India, China, Brazil, and developed economies like you can say Australia, US. So there are a few countries which are doing outperforming the others, and it's a known fact that these economies will continue to be on an uptrend from a longer term perspective. When I say longer term, it can be like 20 years. So, but it doesn't mean that these economies will not fall with respect to the stock market, even though the primary long-term trend is uptrend or upside. It will see some knee-jerk reactions wherein markets will fall down. So let me move on to a particular chart here. So this is the Nifty chart for the last 15 years, and as you can see at the bottom, from 1999, 2000, 2001 to until 2014 till date. So on the left you have the scale 1000, 2000, 3000, 4000. So I'm gonna look at the rally before 2008 and the fall during 2008. Okay, so India 10 years back also it was a growing economy, and it is still a growing economy, even though the growth may be a little lesser or a little higher. Every year that can change a little. So uh, there was the rally started at 2002 from almost 1000 points, and the rally ended at 6300 points. Now if you're interested in finding how to find a peak, I think you should watch my other video where I predict the Nifty peak or the next Nifty peak to be close to 9000 to 10,000 levels. So watch that video. So it hit a peak from 1000 to 6300. So this entire rally phase is what we call it as 100%. Okay, so when we are retracing, how much of this how much of this 100% will we retrace is the question. um, just hold on a minute. So again, if you look at it, the popular numbers are again 38% and 61%. So the 38% retracement of the 5000 point rally is close to like 2000 points, so around 4300. So as soon as it breaks that particular level, markets see a huge sell off again, and finally it settles down around 2500, which is actually little more than 61% retracement. But at those levels it starts finding buyers again, where the overall long term trend continues again. So it's more like we are in a continued uptrend. India is in a continued uptrend, but in the interim, there will be some exits, people exiting and again re-entering back into that trend. So this is a normal chain wherein there is a movement in the upward direction, and then there is a small there is a correction, and the markets again resume the primary trend. So again, here I've actually applied the Fibonacci number, and these are all exceedingly good times to enter as a long-term investor. And similarly, here again it starts a new cycle wherein markets rallied from 2500 to 6300, almost close to a 4000 point rally. This entire 4000 point rally, you can again consider it as 100%, and 40% retracement of that is a 1600 point fall, which again happened. And here Nifty PE was close to 28, and here Nifty PE was close to 25. So those are all good ways to identify a peak. And other good parameters to identify a peak are volatility index above 40, and normally near a peak you will see a lot of IPOs coming in. And the reverse of that, how to identify a bottom, Nifty PE will be pretty close to attractive levels like 12 to 16, and there will be no IPOs. Volatility index will be pretty much like less than 20. So these are all, there are many indicators, the other indicators, supportive indicators that help you find a bottom as well for a long term perspective. So again it retraced 38%, and now we are again into a new bull rally. And this time when we are hitting 6000, actually our Nifty PE is close to only 17 or 18. So there's lot much steam that is left before we hit the next peak, which is why I predict the next peak to be close to 9000 to 10,000 levels. So these are all indicators that I use for a long-term investor perspective. Again, you can apply the same even in a monthly chart or a 30-minute chart, wherein you see a primary trend of an uptrend or a downtrend even, because when you're doing very short-term short-term charts, there'll be a lot of downtrends as well. So in those downtrends, you can see a 38% retracement on the upside, like I'm showing here. For example, when we are coming down, here the markets are again bouncing back by maybe 38% before it continues on the downtrend again. Even in the 2008 fall, you can see that from 6,300 it drops close to 4,300, and then it bounces back from 4,300 to close to like 5,000, 5,100. So that's almost like a 40% retracement or 38% retracement, and then it continues the downtrend again. Again, it hits close to like 3,600 and then bounces back to 4,200. That again is like a 50% or 40% retracement before it continues on the downtrend again. So you can even apply Fibonacci numbers towards intraday chart, but the problem is as you go into the short time frame charts, the time for reaction and the time for calculating all this will become tough, and you will be forced to make decisions very quickly, wherein there will be a lot of noises as well. In a long term chart, you have sufficient amount of time to react and sufficient amount of time to look at other supportive indicators, like I said, volatility index, how much IPOs are coming out, the Nifty P, and all these stuff. And you can make your decisions at your own comfort, because you can even take a month or 2 months to sit and decide, okay, are we close to a bottom? But when it comes to an intraday chart or like a 30-minute chart or an hourly chart, you're gonna have very less time. So, and there will be also a lot of noises, and there'll be a lot of influences because of the external news that can actually break a trend, and that can probably not let the Fibonacci level hold. So those are all the challenges that you have to apply when you go into it from a trader perspective, if you're going to use Fibonacci at a intraday level. But from a long term or relatively longer term charts, you will have time to react, and especially since you're going to be a long term investor, if you're picking the right companies, then you should be fine. Read my book on art of stock investing if you want to learn more about long term investing, how to pick evergreen companies that will survive even the market falls like these. And subscribe to our YouTube channel for more interesting videos that will keep coming from our side. And that's it for now. Thank you. Bye bye.